Hi everyone, you're still in the Completing the Audit playlist right here at Let's Talk Audit and Assurance. And this is the part of the playlist where we get to answer multiple choice questions in order for us to, of course, apply the concepts that we have previously reviewed. So if you haven't yet viewed the video lecture, now might be a good time for you to head on over to that and review the concepts, brush up first on the concepts of completing the audit, and then join us back here to answer the multiple choice questions. However, if you're already done reviewing the concepts, then now would be a good time for us to apply those. So, for the information of everyone, we are going to answer 60 multiple choice questions. But since it's going to be a bit lengthy, we're going to split this segment into two parts. So, we're going to answer the first 30 questions in part one and the remaining 30 questions in part two. Also, I'd like to inform everybody that these questions are not originally mine. I did not personally prepare these questions. These are compiled coming from a variety of sources like textbooks, review materials, test banks, and the like, and have been randomly generated using a test generator. So, having said that, let's answer our multiple choice questions, starting with this question. Adsendo has examined the financial statements of Idiosa Corporation for the year ended December 31, 2020. So, as early as the first statement, we would be able to identify that the financial statement date is December 31, 2020. Financial statement date may also be called the balance sheet date. Although Adsando's fieldwork was completed on February 27, 2021, Adsando's auditor's report was dated February 28, 2021, and was received by the management of Idiosa on March 5, 2021. So from here, we will be able to see the audit report date, which is February 28, and the audit release date, I mean the report release date, which is March 5, 2021. Now, on April 4, 2021, the management of Idiosa asked that Adsendo approve inclusion of this report to stockholders, which will include unaudited financial statements for the first quarter ended March 31, 2021. So, what happened here? Adsendo released the auditor's report together with the audited FS on March 5, 2021. Idiosa, the client, is currently making available to their shareholders the first quarter unaudited financial statements. And Idiosa has requested Adsando to grant approval that the audit report of December 31, 2020 will be included in the interim first quarter report for 2021. Adsando approved of the inclusion of this auditor's report in the annual report to stockholders. Now, under the circumstances, Adsando is responsible for inquiring as to subsequent events occurring through. So, we get to recall what we have previously reviewed about subsequent events. And we're saying basically, subsequent events would refer to events that occur from the balance sheet date up to the date of the auditor's report and facts that become known. We have also previously pointed out that the audit report date is very important because it fixes our responsibility. Up to the audit report date, we have a responsibility to obtain sufficient and appropriate evidence. So, having said that, then Adsendo would be responsible for inquiring as to the subsequent events occurring through the audit report date. And in the case of this illustration, the audit report date was February 28, 2021. So the answer to our very first question is Charlie. Next, which of the following procedures would an auditor most likely perform in obtaining evidence about subsequent events? Okay, so the most likely procedure to be performed for subsequent events. Letter A would say inquire about payroll checks that were recorded before year end but cashed after year end. So we're referring to the checks that were issued before year end but were only encashed after year end. This will not qualify as a subsequent event as this is an ordinary business transaction. Okay, letter B, investigate changes in long term debt occurring after year end. So we get to think about the changes in long term debt that occurred after year end. Perhaps you get to wonder why the classification of the long-term debt that was on the financial statements as of December 31 suddenly became current liabilities, right? So this particular changes in long-term debt could actually signal the presence of a subsequent event that yielded to a change in our example, the classification. So, having said that, letter B is a likely candidate to be the answer to this question. Nonetheless, let's evaluate the remaining two choices. Letter C would say recompute depreciation charges for plant assets sold after year end. And again, this is an ordinary business transaction, okay, that the business would ordinarily encounter as well. Or determine that changes in employee pay rates after year end were properly authorized. Again, this will not be considered as a subsequent event, as this is a day to day transaction of the business. And so, as what we have previously mentioned, letter B is the most likely candidate, and after evaluating all four choices, letter B is indeed the answer. So, bravo for question number two. Let us now proceed to question number three. Which of the following procedures would an auditor most likely perform to obtain evidence about an entity's subsequent event? So, still looking at which one would most likely alert us to the fact that there is a subsequent event. Letter A, examine on a test basis the purchase invoices and receiving reports for several days after the inventory date. And I think at this point you're already getting the gist of how to determine subsequent events, right? Letter A is most definitely an ordinary business transaction, so not likely to yield a subsequent event. Letter B, reconcile bank activity for the month after the balance sheet date with cash activity reflected in the accounting record. So basically, a bank reconciliation. Letter C, review the treasurer's monthly reports on temporary investments owned, purchased, and sold. We are talking about temporary short term investments. Or letter D, obtain a letter from the entity's attorney describing any pending litigation, unasserted claims, or loss contingencies. So, in the case of these choices, the best choice, because we are asked for the most likely to be performed, and I think at this point you're able to recognize it as well. The most likely to be performed will be to send letters of audit inquiry to the client's lawyers or legal counsel. So the answer to this is Delta. Next question. Subsequent events affecting the realization of assets. When we say realization of assets, it simply means the conversion of assets to cash. Okay, so again, subsequent events affecting the realization of assets ordinarily will require adjustment of the financial statements under examination because such events typically represent. So basically this question is asking us if a company is able to convert its asset to cash subsequently, this would be a type 1 subsequent event or that which require adjustment. The question is why? Why is it a type 1 subsequent event? And we remember the type 1 subsequent events are those events which would reveal conditions that already existed as of balance sheet date. So the fact that the company was able to subsequently convert its asset to cash must mean that the asset was already there. It already existed as of balance sheet date. So therefore, the answer to this should be bravo. It represents culmination of conditions that existed at the balance sheet date. Next, on January 15, 2024, before the Adamas Co. released its financial statements for the year ended December 31, 2023, Remy Corp, a customer, declared bankruptcy. So notice it happened on January 15, 2024, before the auditor released the audited financial statements for the year ended December 31. So the company had a customer by the name of Remy who was declared bankrupt. Remy has had a history of financial difficulty. Adamas estimates that it will suffer a material loss on an account receivable from Remy. Oh, by the way, Adamas happened to be the client, not the auditor. I apologize. So the client, Adamas, had a customer who was declared bankrupt. No? And according to Adamas's evaluation or assessment, they would most likely suffer a material loss on this receivable. How should Adamas, the client, recognize this particular material possibility of a material loss? Should it be disclosed or should it be adjusted or recognized? Letter A, the law should be disclosed in an explanatory paragraph in the auditor's report. So perhaps letter A would want us to include some sort of like emphasis of matter or other matter paragraph. Letter B, no disclosure or recognition is required. Letter C, the financial statement should be adjusted to recognize the loss. Or letter D, the loss should be disclosed in the footnotes to the financial statements, but the financial statements themselves need not be adjusted. So the question is, will Remy's bankruptcy be considered as a type 1 or a type 2 subsequent event? One very important thing to highlight is that Remy already has had a history of financial difficulty, meaning to say, as of December 31, 2023, Remy was already suffering financially. So the condition was already present as of balance sheet date. Therefore, it is a type 1 subsequent event, or that which requires adjustment. So, Charlie, for this question. Next, a major customer of an audit client suffers a fire just prior to the completion of the year-end fieldwork. So it's important to point out that the fire occurred just prior to the completion of the audit. Okay, not prior to the balance sheet date, but prior or before the completion of the audit. The audit client believes that this event could have a significant direct effect on the financial statements. So in this case, the auditor should, letter A, withhold submission of the auditor's report until the extent of the direct effect on the FS is known. Letter B, advise management to disclose the event in the notes to the financial statements. Letter C, disclose the event in the auditor's report. Or letter D, advise management to adjust the financial statements. We once again take a look at the scenario here. The customer of the client suffered a fire. When did the fire happen? Just prior to the completion of the field work. Okay, not before the balance sheet date, but after the balance sheet date, prior to the completion of the audit. Okay, so if you take a look at the balance sheet date, then the fire has not yet happened on the balance sheet date itself, right? It happened after the balance sheet date, but before the auditor finished the audit. So in this case, it will be a type 2 subsequent event, one that will require disclosure. Now, the question is, who will do the disclosing? Is it the auditor or is it the client? Of course, it should be the client who will do the disclosure. Similar to how we say it will be the client who will adjust the financial statements, right? So in this case, it should also be the client who will make the disclosure. And since it is the client who will make the disclosure must be made in the financial statements. So the answer is letter B, advise management to disclose the event in the notes to financial statements. Next question. A client acquired 25% of its outstanding capital stock after year end and prior to the completion of the auditor's fieldwork. So, in this case, the client reacquired its own shares. So, the client had 25% of its outstanding capital stock back as treasury shares. This was done after the year end, but before the auditor was able to finish the audit. So, we again try to analyze, when did this event happen after the year end? As of balance sheet date, is there already a condition that existed? Were they already sold as of balance sheet date? The answer is not yet, right? This was only subsequently sold. No condition existed as of balance sheet date that would anchor the acquisition or the reacquisition of these shares. So because of that, this should only be a type 2 non-adjusting or type 2 subsequent event that will require disclosure. So once again, we advise management to disclose the acquisition in the notes to the financial statements. Again, the condition did not exist as of balance sheet date. Next, which event that occurred after the end of the fiscal year under audit, but prior to the issuance of the auditor's report? I hope that when you see these words or you read these phrases, you would be able to somehow visualize the timeline. So the timeline is after balance sheet date, but before the auditor dated or released, rather, before the auditor released his report. Okay. Okay, which of these would not require disclosure? Which would not require disclosure? Letter A, there is a loss of plant or PPE or inventories as a result of fire or flood. So assume, for example, balance sheet date is December 31. On January 2, there was a fire that hit the warehouse and destroyed all of the inventory. As of December 31, the inventory was still there, but On January 2, actually, all of those inventory have been gutted down by fire. So, in that case, that is an example of a type 2 subsequent event, right? It needs to be disclosed. Readers of the FS need to know that the inventory recognized in the financial statements, recognized in the balance sheet, actually is no longer there. So, letter A is a type 2 subsequent event. Letter B, settlement of a litigation when the event giving rise to the claim took place after the balance sheet date. So in this case, the condition took place after the balance sheet date. So if it's after the balance sheet date, then it's most definitely a type 2 subsequent event requiring disclosure only. Letter C, a major drop in the quoted market price of the stock of the corporation. For this, we do get to imagine and envision that the price drop happened on the corporation's own shares of stocks, not as part of their investments in stocks of other companies, right? There was a major drop in the quoted market price of the stock of the corporation. And we know in the case of the statement of changes in equity, we don't actually recognize the quoted market price as the valuation for outstanding stock, right? We do make use of par value, not the quoted market price. So in this case, this will not have any effect. So this will not be disclosed. So the answer to this is letter C. The sale of a bond or capital stock issue that happens subsequently. So say for example, if management was able to sell, or if the client was able to sell, like say a material percentage of their stock subsequently, then that will require disclosure, okay, not adjustment. So the question is, which of these would not require disclosure? The answer then is letter C. Next, an auditor should request that an audit client send a letter of inquiry to those attorneys who have been consulted concerning litigation claims or assessments. The primary reason for this request is to provide, and if you would recall what we have discussed previously, we said in terms of litigations, claims, and assessment, the primary responsibility rests with management. The primary source of information is also management. The letter that we send to the client's lawyers or legal counsel will simply serve as a corroboration. So the lawyers are a source of corroborating information. So the answer to this should be bravo. The corroboration of information furnished by management concerning litigations, claims, and assessments. And on a very similar question, just to, as I have said, these are actually coming from a variety of sources. So it is possible that different sources may have a similar question, just like this one. Actually, the question is very similar. Why do we give or why do we send a letter of audit inquiry to the lawyers or the legal counsel? And the answer will be the same. It's to serve as a corroborative evidential matter. So it should be bravo for this number. Next question. An auditor will ordinarily examine invoices from lawyers primarily in order to, so we're basically looking at the professional fees account. Examining the invoices of the lawyers is our way of testing the professional fees account. Why do we do that? Is it to letter A, estimate the peso amount of contingent liabilities? Letter B, is it to assess the legal ramifications or the legal consequences of litigation in progress? Letter C, is it to substantiate accruals? Or letter D, is it to identify possible unasserted litigations, claims, and assessments? So, what will we get out of examining the invoices from lawyers? The answer here, of course, is letter D. Because, as what we have previously mentioned in the lecture video, it is possible for us to notice a sudden uptick or a material increase in the professional fees account, which could represent services being offered by the legal counsel, for example, or an external lawyer, for example, in representing the client before a legal case and such similar things. Okay, so the answer to this is delta. Next, the scope of an audit is not restricted when an attorney's response to an auditor as a result of a client's letter of audit inquiry limits the response to. In other words, which of these four responses would sit well with you? Which of these four responses would you accept, as okay? Meaning to say you will not consider it as a scope limitation. Is it letter A, if the lawyer will limit the response to an evaluation of the likelihood of an unfavorable outcome of the matters disclosed by the entity, meaning to say the lawyer will only give you an evaluation of those matters that have already been disclosed by the entity. Or B, matters to which the attorney has given substantial attention in the form of legal representation. Or letter C, the probable outcome of asserted claims and pending or threatened litigation, or the attorney's opinion of the entity's historical experience in recent similar litigation. Perhaps in the case of letter D, the lawyer might want to tell you about, or yeah, his opinion about whether this client has been winning in legal cases in the past or not. So in this case, if we talk about which one, okay, will not be considered as a scope limitation, the answer actually to this is letter B. If the attorney limits his or her response to matters for which they have given substantial attention to. Now, why not letter A? In the case of letter A, notice that the attorney will only be telling you about items that have already been disclosed. But our concern is for cases of undisclosed or unrecognized or unasserted claims. So, meaning to say, in terms of litigations, claims, and assessments, the assertion we are most interested in is the assertion of completeness. So if the lawyer limits it to letter A, then it is only able to answer the assertion of existence, right? So therefore, the answer to this one is bravo. Next, what if the attorney refuses to provide information that is requested by an auditor in an inquiry letter? Okay, so the attorney just simply refuses to respond. The auditor then considers this to be, letter A, equivalent to a reportable condition. When we talk about reportable condition, these are conditions that are to be reported to those charged with governance. Letter B, we will consider it as a limitation in the scope of the audit. Letter C, will it be a reason for us to withdraw from the engagement? Or letter D, will it be a ground for adverse opinion? So what happened here? The legal counsel refuses to reply, and so this one will be considered as a scope limitation. Okay, and we know if it's a scope limitation, it may result to either a qualified or a disclaimer of opinion. So bravo for this number. Next, for audits of financial statements made in accordance with GAAS or Generally Accepted Auditing Standards or our PSAs, the use of analytical procedures is required to some extent, number one, as a substantive test, or number two, in the final review stage. And we once again recall substantive tests are so widely used that they are used in the planning, testing, and completing phase. And out of these three phases, it is only optional in the testing phase. So therefore, it should be a no to the substantive test, but a yes in the final review stage. So the answer to this is delta, no, and yes. Next, which of the following ratios would be the least useful in reviewing the overall profitability of a manufacturing concern? Is it letter A, net income to net worth, letter B, net income to working capital, letter C, net income to total sales, or letter D, net income to sales? So these are things we would normally be encountering when we perform analytical procedures. And to this, you have to call to mind, you have to let surface your appreciation of ratio analysis. We are being asked here which would be the least useful when we review the overall profitability of a manufacturing concern. And the least useful here is bravo. When you simply compare net income to working capital, it is not able to fully capture how effective the business is in getting returns from, say, for example, its assets, as this one does not consider non-current assets, nor does it consider the presence as well of non-current liabilities, especially in the case of a manufacturing concern where it is very capital intensive, meaning to say it does spend a lot in terms of its non-current assets. Then net income to working capital will be the least useful when you assess the profitability or the performance of this particular client. So the answer to this is bravo. Next question. Adam, CPA, believes that there is a substantial doubt about the ability of EAD Company to continue as a going concern for a reasonable period of time. In evaluating EAD's plans for dealing with the adverse effects of future conditions and events, Adam most likely would consider as a mitigating factor Ead's plans to. Okay, so what is the story here? Adam, the auditor, has a client, and the client's name is Eid. Now, based on Adam's assessment, Eid might have a substantial doubt about whether it can still continue or go, or about whether it can still continue and use the going concern basis. So, because of this one, okay, Adam would consider as a mitigating factor. What is a mitigating factor? Mitigating means it causes something to become less severe. Okay, so it somehow tones down the effect of this doubt. Okay, so which of these four would tone down the doubt? Okay, which one would make you question the doubt? Which one would make you doubt the doubt? Okay, so in other words, which of these four would likely tell you that Eid is stronger than you think? So letter A would say Eid is able to negotiate reductions in required dividends being paid on preferred stocks. So say for example, if Eid was due to pay the preferred shareholders 1 billion for this current year, Eid was able to negotiate it to be reduced to, let's say, 30 million, for example. Okay, so will that likely make you feel that, well, Eid still has a chance? It might still be going concern after all? Or B, accumulate treasury stock at prices favorable to Eid's historic price range. In the case of letter B, Eid, the client, is buying back its own shares of stocks. And to this, we get to imagine if Eid is buying back its own shares of stocks, then effectively it's releasing cash, right? It's releasing cash in order to buy these back. And we know that in terms of bankruptcy proceedings, liquidity is a more common reason as compared to profitability. So in the case of letter B, it's actually putting the liquidity of Eid at risk. How about letter C? Purchase equipment and production facilities currently being leased. And again, to this, we get to imagine that they are purchasing what they have previously leased. So if you think about leases, then that means they probably are paying for it annually. But once it is purchased, they have to pay for it at a one time, right? So again, in the case of letter C, Eid is not holding on to cash. Eid is releasing cash, thereby putting their liquidity at risk. So, not letter C. Letter D, accelerate research and development projects related to future products. Again, accelerating research and development projects would necessitate the outflow of cash, which would then again put Eads liquidity at risk. So, of the four, the only choice where we get to see Eid saving up on cash is letter A. Now, why are we concerned about Eid saving up on cash? Because, as what we have previously mentioned, in terms of bankruptcy proceedings, liquidity is a more serious concern as compared with profitability. So, we want to see Eid protecting their liquidity. So, the answer to this is alpha. Next, which of the following audit procedures most likely would assist an auditor in identifying conditions and events that may indicate substantial doubt of an entity's ability to continue as a going concern? So, which of these four will most likely alert us to the fact that there is substantial doubt? Letter A, reconciling cash balance per books with the cut-off bank statement and the bank confirmation. So, will a bank reconciliation show you indications of significant doubt? Or letter B, inspecting title documents to verify whether any assets are pledged as collateral. Or letter C, confirming with third parties the details of arrangements to maintain financial support. What do we mean by financial support? If you've ever heard the word bailout, for example, when, say, for example, the head office or the mother company bails out the component or the affiliate or the subsidiary, so that is an example of a financial support. So we confirm with third parties the arrangements regarding financial support. Or letter D, comparing the entity's depreciation and asset capitalization policies to other entities in the industry. In this case, the correct answer is letter C, right? Because if the client is already maintaining some sort of financial support, then most definitely you can say that the client may have substantial doubt. Okay, most definitely, and then may. They don't, like, ever. Never mind, never mind. So the answer to this is letter C. Next, an auditor's tests of pricing of a client's inventory indicates the existence of many errors. However, because of inadequate records, the auditor is uncertain about whether these errors materially affect the financial statements taken as a whole. The auditor may reasonably issue a or an statement 1 subject to qualified opinion, but we know that in the Philippines, we do make use of except for, not subject to, and number 2, adverse opinion. And for this, we know that there is inadequate records, and so therefore, the auditor was not able to test the misstatements per se because there were no records. So the inability of the auditor to test for misstatements will result, of course, to a scope limitation. So the choice then of the auditor would have been an except for qualified opinion or a disclaimer of opinion. So in this case, it's going to be a no and a no. Next, Sando CPA suspects that a pervasive scheme of illegal bribes exists throughout the operations of Bini Import Export Inc., a new audit client. Sando notified the audit committee and Bini's legal counsel, but neither could assist Sando in determining whether the amounts involved were material to the financial statements or whether senior management was involved in the scheme. So neither the audit committee nor the legal counsel was able to help the auditor. Under these circumstances, Sando should, letter A, express an unqualified opinion with a separate explanatory paragraph, or letter B, disclaim an opinion on the financial statements, or letter C, express an adverse opinion on the FS, or is it letter D, issue a special report regarding illegal bribes. So in this case, because Sando was not assisted by either the legal counsel nor management or nor TCWG, then Sando was not able to perform the procedures necessary to determine the presence of these illegal bribes. And so, therefore, the worst thing that Sando can give is a disclaimer of an opinion. So, the answer to this is letter B. Next question. In the course of the examination of financial statements for the purpose of expressing an opinion thereon, the auditor will normally prepare a schedule of unadjusted differences for which the auditor did not propose adjustments when they were uncovered. So, normally, not all of the misstatements that the auditor was able to notice during the audit will be submitted to management for proposed adjustments. So, if there are certain adjustments that the auditor did not give to management or did not propose to management to adjust, the auditor will prepare a list of unadjusted differences. What is the primary purpose of the auditor collating or making this list of unadjusted differences? Is it letter A, to summarize the adjustments that must be made before the company can prepare and submit its federal tax return? This sounds like US multiple choice question because of the federal tax. Of course, in the Philippines, we do not have federal tax. Letter B, to summarize the errors made by the company so that corrections can be made after the audited financial statements are released. Or is it to identify the potential financial statement effects of errors or disputed items that were considered immaterial when discovered? Or is it letter D, to point out to the responsible client officials the errors made by the various company personnel? It's kind of like your way of squealing to management. No, who are those personnel who like, to point out who are the responsible personnel for the errors. But anyway, in this case, why do we prepare a summary of unadjusted differences? Well, it's to help identify, right, the potential for financial misstatements because upon discovery, and individually they may be immaterial, but we would like to see if they don't really have any further implication on the financial statements. So the answer to this is Charlie. Next, which of the following documentation is required for an audit in accordance with generally accepted auditing standards? Is it a client engagement letter, an internal control questionnaire, a client representation letter, or a planning memorandum or checklist? And the answer to this one is a client representation letter. In the case of an engagement letter, this is highly encouraged to be used, but is not really cited in the standards as one being required. In the case of an internal control questionnaire as well, this is just one of the many ways where the auditor can evaluate or can obtain an understanding of the client's internal control system, but there are many other ways. And in the case of a planning memorandum or checklist, what is required is for the auditor to perform audit planning and to come up with a written audit plan and program or audit strategy and plan, but they did not actually require the use of a planning memorandum. What is required is for the auditor to produce a written audit plan. Okay, so in this case, the answer is Charlie. Next, when an examination is made in accordance with PSAs, the auditor should always, letter A, obtain certain written representations from the client, letter B, observe the taking of physical inventory on the balance sheet date, letter C, document the auditor's understanding of the client's internal control system, or letter D, employ analytical review procedures. Now, this one is quite tricky, as if you would evaluate most of the choices, they might actually contain some grain of truth in them. For example, if we talk about employment of analytical review procedures, there are certain areas in the audit that will require this, right? Like in the planning and in the final completion phase. Or when you talk, for example, about obtaining certain written representations, in the case, for example, of general representation, general written representation, that which will talk about the premise of the audit, then that is required. But if you talk about specific written representations, then while it is a common practice, but it is not required for all. Okay, so there's a certain element of a non-requirement in the case of both delta and alpha. In the case of observing the annual physical count of your client, it does not necessarily have to be done on balance sheet date. So it is not also Bravo. Therefore, what is required here is the documentation of our understanding of the client's internal accounting control system. So that should be Charlie. Next, a purpose of a management representation letter is to reduce, letter A, the scope of an auditor's procedures. But for this, we are reminded that while written representations are part of audit evidence, they cannot be a substitute for the auditor's audit procedures. So it cannot reduce the scope of your procedures. It does not have that power. So not letter A. Can it reduce audit risk to an aggregate level of misstatement that could be considered material? This one kind of sounds weird because you want to reduce it to a level that is considered material. If you want to manage audit risk, then it should be to a level that you will be willing to accept, right? So, not letter B. Letter C, an auditor's responsibility to detect material misstatement only to the extent that the letter is relied on. But then again, as what we have pointed out, this will not have any impact on the scope of your work, and this cannot be used as an excuse for you not to perform procedures. So therefore, the main purpose of this is to reduce the possibility of misunderstanding. This is the reason why we ask for, especially general written representation so that management could fully be reminded and could understand their responsibilities towards the financial statements. Next, as part of an audit, a CPA often requests a representation letter from his client. Which of the following is not a valid purpose for such a letter? Letter A would say to provide possible protection to the CPA against a charge of knowledge in cases where fraud is subsequently discovered to have existed in the accounts. Or B, to satisfy himself by means of other procedures when certain customary auditing procedures are not performed. Or letter C, to emphasize to the client his responsibility for the correctness of the financial statements. Or letter D, to provide audit evidence. Let's try to evaluate this one bit by bit. Starting with to provide audit evidence, can written representations be part of evidential matter? And to letter D, we say yes, it is. It is part of evidence. So letter D is correct. What we are looking for is the incorrect. Letter C, can it help emphasize? Will written representations help emphasize the client's responsibility for the correctness of the FS? The answer is yes. Management has to outline and to confirm in writing that they are the one responsible for the financial statements. Will a written representation allow the auditor to be satisfied of other auditing procedures when certain customary auditing procedures are not performed? Meaning to say, if the auditor was not able to perform an audit procedure, the representation letter or the written representation will already make the auditor satisfied as to the objective being tested. And to this, we say no, because the auditor cannot use the written representation letter as a substitute for actual evidence gathering procedures. So the answer to this is bravo. Next, an auditor should obtain written representations from management concerning litigation claims and assessments. These representations may be limited to matters that are considered either individually or collectively material, provided an understanding on the limits of materiality for this purpose has been reached by, so meaning to say, who would reach an understanding regards the concept of materiality in the case of litigations, claims, and assessment. The answer to this one will be the primary source of the information, which is management, and of course, the auditor. Okay, so especially in cases of litigations, claims, and assessments. So it will be both management and the auditor. Next, to which of the following matters would materiality limits not apply in obtaining written management representation? So, in other words, which one of these four cannot use materiality as a reason? Letter A, losses from purchase commitments at prices in excess of market value. Letter B, availability of the minutes of stockholders and directors meeting. Letter C, reductions of obsolete inventory to net realizable value. Or letter D, the disclosure of compensating balance arrangements involving related parties. Of the four, which one do you think will least likely be affected or will least likely be an application of materiality? And in this case, we should be able to recognize that the answer is bravo, because it's either they make available all of the minutes of meetings, but if they, for example, left out one or two meetings, but then what if in those meetings the most significant matters were discussed, right? So you cannot, it's not, it's difficult rather, it's difficult for you to apply materiality in this context. So, because again, one meeting does not automatically equal to just one concern. It's possible for it to be one meeting, but the most significant concern was discussed there. So all minutes of meeting should be provided to us. So that is bravo. Next, which of the following statements ordinarily is included among the written client representations obtained by the auditor? Letter A, that sufficient evidential matter has been made available to permit the issuance of an unqualified opinion. Will the client write this one? Okay, up to that point where we say sufficient evidential matter has been made available, that's okay. But then, if the client says to permit the issuance of an unqualified opinion, it gives the impression that the client is the one demanding for the type of opinion they want. So it's not letter A. Letter B, that management acknowledges responsibility for illegal actions committed by employees. Letter B is simply not true. Can you imagine, for example, the thousands of employees in a particular business, and should a particular employee, say, for example, jaywalk or steal something not part of the work and not coming from the company? So the personal lives of their employees are not within the jurisdiction of management's responsibility. So not letter B. Letter C. Compensating balances and other arrangements involving restrictions on cash balances have been disclosed. Okay, so should management tell us that if there are compensating balances, we have already disclosed it, or management acknowledges that there are no material weaknesses in internal accounting controls, but then we do recall that our opinion is on the financial statements, not on the internal controls. So the answer to this one is letter C. Next, there are violations or possible violations of laws or regulations whose effects should be considered for disclosure in the financial statements or as a basis for recording a loss contingency. This passage most likely comes from, okay, so let's read it again. The statement says there are violations or possible violations of laws whose effect should be considered for disclosure in the financial statements or as a basis for recording a loss contingency. Who will say this? Okay. Will you find this in the client engagement letter? Will you find this in the attestation report? Will you find it on the report on compliance with laws and regulations? Or will you find it in the management representation letter? So again, we are saying management representation letter sets out or outlines the premise of the audit. So this one is delta. This is likely, we will likely read this one in a management representation letter. Next, because of the pervasive effects of laws and regulations on the financial statements of governmental units, so we're talking about governmental units here, an auditor should obtain a written management representation acknowledging that management has, letter A, reported all known illegal acts and material weaknesses in internal control structure to the funding agency or regulatory body, or documented the procedures performed to evaluate the governmental unit's compliance with laws and regulations? Or should there be a management representation that identifies and discloses all laws and regulations that have a direct and material effect on the financial statements? Or will there be a written representation about the implementation of internal control policies and procedures designed to detect all illegal acts? So, in this case, because we are obtaining the written management representation, owing to the pervasive effects of laws and regulations in governmental units, management must confirm in writing that they have identified and disclosed all laws and regulations because, after all, it is the primary responsibility of management not only to design internal control procedures that will help them identify and detect the said effects, but also for them to make this known to the external auditor. Next, Hall accepted an engagement to audit the 2025 financial statements of XYZ Company. XYZ completed the preparation of its 2025 financial statements on February 13, 2026, and Hall began the fieldwork on February 17, 2026. So, Hall completed the fieldwork on March 24 and completed the report on March 28. We have said previously that the client's representation letter should normally be dated the same date as the audit report. So in this case, the audit report is dated March 28, 2026. Therefore, the representation letter should also be dated on March 28, 2026. So those are our first 30 questions covering part one. We still have 30 questions more for part two. So perhaps this is now the time for you to take a very quick break, take a sip of water, drink your liquids, stretch out a bit, maybe do some light stretching. It would be a good idea. And then hopefully when you're up and about, then join me again for part two, where we get to discuss the remaining 30 questions.